Welcome to Capital Discussions weekly market review. Jim Riggio and I are going to look at what happened last week and what's going to come up next week. Before we get started, we have a disclaimer that this whole presentation is for educational purposes only. We don't know you or your situation, and Capital Discussions is not an investment advisor. We have no way of knowing what level of risk is appropriate for you. So with that, Jim, we can get started and take a look at what happened last week.
Great, Tom. Thanks a lot. Last week was a rather interesting week, especially that happened on Thursday. If we take a look at the entire week from last week, we had looked through what was going to be going on. There was some retail sales, some industrial productions. It wasn't until we got to Thursday morning, before everything started, that housing starts and housing permits were a little bit weak. Remember, okay, on our website at Capital Discussions, the thing I really end up taking a look at is the market reflection. If you've missed the day or if you've missed a week, a paragraph or two each day will end up telling you what ended up happening. We started the day, obviously, with the economic numbers. By midday, it was the Malaysian airliner. It was shot down. I wasn't sure about if it was terrorist or what ended up happening, and the market started to sell off. Later that day, we had Israel actually moving into Gaza. So their conflict had escalated so that they actually started with ground troops, and the market ended up starting to sell off. The thing that I noticed, Tom, when we were looking at it, is that there was a lot of uncertainty, and what I saw was that the VIX, okay, on the volatility index on the S&P 500, started to end up moving up much quicker than other things. It was moving up earlier in the day, and I'll show you the graph of it. Okay, the VIX is the bottom line, okay, for the week. This is a 15-minute chart. I'm using Thinkorswim. We've talked about this, right? This is, I use this in my Roth IRA account that we're publishing, okay, on the site. We started to see the VIX, as you can see from down here, starting to move up. Now, we were moving at very low levels, right? Volatility had gotten crushed the day before. This is Wednesday in here. The interesting thing was that the monthly futures, as shown by the purple line, okay, which are the futures on the VIX that expired, okay, for July. They don't have weeklies. They only have monthlies. The July futures ended up expiring. We had our normal push down, okay, on the expiration of the opening print, and we continued to drift down. So we were at some very, very low levels. So the housing starts came out. We were a little bit worried about things. We started to end up moving up. When we found out that the Malaysian airliner got shot down, we started another leg up. Then what ended up happening was that towards the end of the trading day, we found out about Israel. And here's what I wanted to end up showing you, what I found most interesting. While we had this big pop up in the VIX, we didn't move up nearly as much this is the first month future. This is the August, the September, and the October future on the VIX. We started to move up, but not that much. After we got to the afternoon with the situation with Israel, you can see the green line moving up, much, much higher here compared to the futures, okay? And then in the very, very end, okay, I'd say around 3:30, 3:45, we kind of hit a peak and we started to sell off. I know that some people end up looking at VIXCentral.com, and I do love that site. I think it's a great, great free site. If we end up going back to, sorry about that.
No problem.
If we end up going back and starting to look at through history, okay, because I do love their site, and it's a great way to be able to do things. But here's a good point where if you're not trading, if you're not looking, you can end up actually missing trading opportunities. If we end up taking a look at the VIX futures as they're priced. For those of you that haven't seen this, okay, what they end up doing is that they actually list out each of the months. So, for example, I'm on July 11th, which is the close of the Friday of the previous week. Okay, we can end up seeing where the Julys were, where the Augusts were in terms of their pricing. And this is a very typical curve when we go from lower left to upper right. The front month futures tend to end up being less expensive than the back month futures. And this is a normal environment where we end up seeing, it's called contango. One of the things that we take a look at all the time, okay, and they've done a really nice job here of showing you where the difference is as a percentage. So what we're looking at, the difference between the first and the second month futures, okay, where they are in terms of which one is higher. When you have the normal environment from lower left to upper right, you'll see positive numbers, and they'll end up being considered to be contango. When there is fear, those front month futures will pop up much more than further back month futures. And when the front month, okay, ends up going and becomes more expensive, that's considered backwardation. He's done a really nice job. I love the way he has his days to expiration down here. So when I end up selecting here, not this past Friday, but a week ago Friday, you can see there were 4 days to expiration because remember I told you that the July contract expired on Wednesday morning's print. So I'll take a look at the one that's going to be open all week long, and this is the August contract. And you can see it was at 13.20. If I walk you through, okay, this for the week, and you can do this with single graphs. I like to do this one time. I don't know if you ever do this. If you keep multiple days here from your start date and you just hit next, what happens is that it draws the line over for you. And if you're not sure which color is which, he lists them all up here. So this was Monday, right? This was Tuesday. Nothing's going on. This is Wednesday. Now here we go, right? Thursday's the big day. Where's the huge jump? You know, I kind of missed it. It didn't look like it was a yes, volatility moved up. It was a bigger percentage move. The futures, as you go further out, hardly moved at all. We're still in contango by 4%. It's not like we went into backwardation. And then if you go to Friday, we're back down to where we were.
Right.
So when you looked at this, you kind of missed it. Whereas if I use the Thinkorswim graph, okay, and I actually map everything out in 15 minutes, I can see that we ended up peaking at 15:30. This is East Coast time. So we started to peak at around 3:30, and then we started to end up coming back in. Now, this was very different than what you were looking at, Tom, because you were actually looking at the prices of the S&P 500 futures, weren't you?
Correct. Yep, the ES contract.
Right? Why don't you end up showing everybody, okay, the graph, if you can take back the ball and you take a look at how the futures were moving, because this was the disconnect. Well, you take back the ball. This was the disconnect that I saw. I saw the VIX moving up during the day quicker than I saw the SPX dropping. Then at the end of the day, I saw the volatility, you know, the VIX and the VIX futures starting to drop, but I saw the price of the S&P 500 starting to, or at least continuing to go down. So I saw the turnaround with the VIX and the VIX futures happening before. Okay, we saw the futures or the S&P cash, and that happens often.
Right. So, can you see my screen first?
I can, yes.
So what you're looking at is just, if I turn this cursor off, the left side is Thursday, the right side is Friday, and the futures trade 24 hours. So you can see by looking at the volume when the regular market hours are. So
that dotted line, Tom, is that midnight or when is that?
That is midnight my time, which is, I'm living in Europe, so that's, Paris time, for instance. So we're
right,
6
so
hours.
That's 4 p.m., so that's market close for us? Is that right?
Correct.
Okay.
Well,
4
no,
p.m.
at 0 to 24. That's 6 p.m. It's
6 p.m.
18.
Okay.
Yeah. Okay, so what I was looking at, I saw the headlines and the plane crash, the plane getting shot down, and I did a lot of technical analysis and chart pattern reading with Joe Ross, and I was looking at this kind of formation, and this kind of looked like it wanted to go lower to me. So I was, I have a bigger position in SPX that I wanted to hedge, so I wanted to get some short deltas. So I ended up buying 2 August 1950 puts, which at the time were, I think, about 15 points out of the money. Here's where the put level was, and I was buying up here, in 1948. Right here's when I bought it. And then the market went down and came back up a little bit, and it's like I want to, well, actually an hour later, 2046, right here. Oh, let me turn the crosshairs on. 2046. Right about here, it had sold off enough that the strike below the 1945s were actually selling for more than I had bought the 1950s for. So I couldn't resist, so I sold the 1945s, created a net credit on the trade. So if the ES futures close above 1950 at expiration, I keep $25, which is my worst case. If it closes at 1945 or below, I make $525, and I'm playing with the house money. So it's, I was up about $160, so I was actually risking that unrealized profit. Some people say that's a riskless trade. In a sense it is, that I'm not putting anything out of pocket, but I had an unrealized profit that I was willing to put back in the trade, so that's what my real risk was. So I had done that, and then the market kept selling off, and I was like, oh man, I wish I was actually short delta, which is what I wanted to do in the first place. So at 2136, which is right here, I could see the market melting down. I was like, well, I need the hedge back on, so I just shorted 2 futures contracts. It went down and came back up, and I was like, well, this is a good chance to make it more what I really wanted, so I sold 2 more futures contracts. And then it bounced around and just started selling off. And at this point, it was about 11 points below where I'd sold it. I was getting $200 a point, so the position was up $2,200, so it was doing really well. And then the market started coming back, and I was worried that it was just a reversal pattern. It was going to keep going, which it was right. It ended up doing that. But I wanted to make sure that I didn't lose anything on the hedge, so I put a buy stop in about 75 cents below where I sold the original futures contracts, which happened to be just above this, right about here, right above this long consolidation period overnight. So every time I kept checking it before I went to bed, I was within 2 or 3 points of getting, a quick rally up and getting filled. And it's like, well, I got to go to bed. That's the one bad thing about trading 24 hours is you can't sleep if you're worried about the market, unless you put some stops in. So I had the buy stop, went to sleep, and not too long after I actually did go to sleep, it got filled. I made $150, and the market just kept going up. If I hadn't put that buy stop in, I would have been down about $3,400, somewhere up here. So if you do put a hedge on with the futures, make sure you put stops on to take yourself out in case you're wrong.
Right. So it was really nice, because the thing is that, I kind of take a look at this, and the thing that I found most interesting, was that you ended up putting on a trade where you were basically short the S&P 500.
Right.
Okay. And you ended up catching up to it. You were able to end up taking care of yourself. I ended up looking at the other way around. Okay. And it was quite interesting, because what I took a look at is that when the volatility expanded and was kind of like leading the market down, it turned first. And I have to share my, did you make me presenter, or do I need to share my desktop? Can you see it?
Go ahead.
Okay. Anyway, so what ended up happening was that I ended up seeing the volatility stop selling off. Okay, so what I ended up doing was that I looked and um, in the IRA account, and just another quick, okay, note or disclaimer for those of you that haven't seen this before. I had a very small amount of money in a Roth IRA. I decided to end up trading it extremely aggressively because it wouldn't make a big difference in my life if it had gone to zero. So I was willing to end up losing all of this. So if anybody who's looking at this, please, okay, this is not, money that's important, okay, for my retirement. This was just a small account on the side that I said, hey, let me try to trade this really aggressively and get it up to a bigger number where it would make a difference.
Right.
And we post these, and Tom, at the end, maybe you show everybody where we end up posting these things. The trades that I end up doing in here, they're almost always on the S&P 500. Only when we have volatility opportunities will I do anything differently. What I ended up seeing is that there are two ETFs, really three ETFs that are worth talking about because there's enough volume in them. One of them tries to end up emulating the S&P 500, and that one's called VXX.
Okay.
What I look at all the time is I look at how the VXX moves compared to the VIX. Because of that contango that we just talked about over here, and I'll just go to term structure of the way we are, because of that contango, which, by the way, usually is 4 to 7, maybe 4 to 8% recently, recently being over the last 2 to 3 months. That means that's how much of a drag the VXX is going to have on the S&P, on the monthly performance when compared to the volatility index of the S&P 500, which obviously is the VIX. So it's a product that is sometimes a lot of people want to be short. Most brokerages, okay, won't let you short it because it's hard to borrow. Those that will let you short it will charge you interest rate, basically a hard to borrow interest rate fee on it. They can end up getting to be a little bit more significant. So instead of trying to short the VXX, there's an inverse of that you can end up trading, which is called the XIV. The simple trade, if you want to end up shorting it, is, and you're not allowed to short in an IRA or if you just can't end up shorting it, just buy the XIV as a replacement. I will tell you that this moves dramatically. On Friday, you can end up seeing that the VXX was down nearly 7%. The XIV, they tend to end up being very, very close. If there's a difference like this of more than 0.5%, it's usually because it's catching up from the day before. They tend to end up being pretty much lockstep, day to day, a little bit different. The VXX, because it's a short, it does have different parameters, so it's not dollar for dollar over a month period or a year period. It's usually dollar for dollar or percent for percent on a daily basis. And that's another whole discussion that we won't get into. Even worse than that, there is a 2 times leveraged long VIX called the UVXY. It has factors that not only does it have contango drag, but it also ends up having that double leverage factor where you know how all double and triple leverage ETFs are designed over the long run to go to zero. They go to zero, both the bullish and the bearish, they both go to zero because of the math behind it. The one comment I will end up making, again, if people want, we can end up doing a whole ETF, WebEx on how the ETFs work. But I'll just make the comment, the more daily volatility and fluctuations you have in price, the quicker the ETFs will lose value. So when you take a look at what ended up happening here, okay, on the UVXY, we were up the day before, I forgot what the percentage was, but it was in the 20s. Right. So this is not for the faint of heart. Okay. These things move around dramatically. So what I ended up doing at around 3:30 in the afternoon, I said I want to give the index time. I was not thinking like you, Tom, short term. I was thinking longer term. I want to end up giving this time so that the contango, if we do stay in contango, um, it'll take effect and it'll drive the price down. And I want to end up taking effect of the fact that if we have increased volatility on a daily basis, the ETF, okay, the double leverage, would also end up losing value. So those were the two things that I was looking to take advantage of. And when I take a look at what was going on with the chart, okay, and let me just go back to, let me just clear all of these studies that we had on here. Okay. And if I take a look at what happened with the UVXY, you can see the very large spike that we ended up having. Okay. We went from, let's call it 24 to almost 29 and a half at its peak. It just started to end up coming back down, and look at how much it got crushed. Okay. So we were up here, 20, actually from even further, because we were a little bit low. We were up in the mid 20%, okay, is how high we ended up moving. So when we ended up getting that level of a jump, the only way the UVXY can continue to move higher is if volatility continues to spike, and at some point that contango that we talked about has to go into backwardation. The front months have to go higher than the second months in order for it to end up having any sustained move higher. Without a sustained move higher, there is an opportunity to end up trying to, if you will, catch the falling knife, okay? And if it starts to move back, it can be very, very profitable. It's also a high-risk, high-reward trade. So if it does keep going, it can end up moving rather substantially. So one, I can't because it's an IRA account, and two, because the risk reward doesn't make sense, in my opinion, just to end up shorting it. Yes, you're going to be right most of the time, but oh my God, you're going to get killed, okay, if it continues to go. So the trade that I decided to end up doing was a little bit longer term, and I took a look at how expensive the puts were, okay, going down, and where the implied volatilities were, which kind of gave me a feel for the price. And what I ended up wanting to do is I wanted to get as close to a 1-to-1 risk-reward ratio as possible. I wanted to risk one to make one. So I was looking at buying a $10 spread below the money for as close to $5 as I could find. And so what I ended up doing was that I looked and I tried to end up buying, okay, on the skew, the lowest implied volatility that I could, and sell the highest one while still being in the direction that I wanted to end up going. What I end up using for this all the time is that I end up using Livevol. And what I ended up doing for Livevol is that here is the daily charts of the S&P 500. Here's the drop that we had on Thursday. Here was the jump in the volatility. The red line is basically the VIX, right? It's the 30-day implied volatility for the S&P 500. Well, that is the VIX. Their calculations are almost spot on. They're doing their calculations because they're doing more of an average, where the VIX is going through a very specific formula to be able to end up finding it. But you can end up seeing how the 30-day jumped more than the 60-day. The 60-day jumped, jumped less. The 30-day jumped more than the 60-day. The 60-day jumped more than the 90-day. And we saw that happen also in the futures. So we had this confirmation that everything ended up looking very, very reasonable. What I started to end up doing was that I looked at how steep, I always start with this, I looked at how steep the put skew was. Let me explain. I try to end up looking at the monthly numbers, and what we're looking at here is each of these dots is an implied volatility for a specific strike. If I come over here and let's just take a look at maybe a specific strike, what I'll end up doing is that here is, let me get to the 1900, because I think that's one of the ones you traded. What will end up happening is it'll show me where the implied what the bid and asks were and what the implied volatilities were for that specific strike. Now, the reason why that's so important is that the implied volatility tells you how expensive any option is relative to another. Think about the way it's calculated. It's the current market implied volatility. When you go through, and I don't care which implied volatility or which options pricing model you use, Black-Scholes or anything else, all of the inputs, price of the underlying, strike price, expiration date, dividend, risk-free rate instead of having to borrow the money, all of those things are known. The only thing that's not known is the level of volatility you need to put in the formula to get the price. Well, if you reverse engineer it, if you say, well, what's the market trading at? I already know the price. It becomes a pretty easy algebra question where you can end up actually calculating the volatility. That's why we call it implied volatility, because given the current market price is implying that we need to use this level of volatility. And everything is normalized to a one-year standard deviation. So the bottom line on this is that when I take a look at implied volatility of any given price on different months, and you can see I have most of them grayed out here because otherwise the chart just gets too confusing. I can end up seeing where the Septembers are, or the Octobers, or the Decembers, and I can see where the implied volatility is. This is a very typical way that we end up looking, where the puts below the money, and you can see right here the price, the puts below the money are always going to be higher than the calls above the money. What ended up happening is that we got very steep, meaning that the puts further and further below the money got to be a lot more expensive than the calls above the money. And if you're going to be trading options at all, you have to end up understanding those relationships. The thing that I really like about this model too, by the way, it's three-dimensional. You can kind of turn and take a look, and you can how things get to end up being. The other thing that you can end up doing is that you can end up going back and looking at what this curve looked like for 2 years or longer. So if I end up, I can end up picking a specific day, moving the cursor, and I can see what the implied volatility actually looked like on the 14th. Okay, what it looked like on the 15th, what it looked like on the 16th, and I can end up seeing where the implied volatility ended up changing. 17th, we jumped a little bit. So how much worse did it end up getting, okay, and how steep that it got? I also looked at that, okay, in terms of the overall market, but then when I go to pick strikes, okay, and this is how I got to the strikes that I chose, Tom, when I was looking at the UVXY, I did the exact same thing over here, and I took a look at the UVXY position, and I pulled up this chart, and let me get all of these, because we actually want to see these, more of these. So what I ended up doing was that I looked at specific strikes. I had to choose all of them because it goes so far out. And I honed in on January. And at the time, you can see right here, here's the 15. But when I put on this trade, I bought the 25, which was a little bit lower than everybody else's. This came down just a drop, and the 15 was a little bit higher in its graph. So one of the things now I have the price advantage in my favor right now, right? You can see that the 15 is pretty low, so I know that my P&L is exaggerated a little bit compared to what it should be because the 15's been pushed down so much. But I ended up buying, okay, the specific strike that was pushed lower, and then I sold a specific strike that was pushed a little bit higher compared to the normal curve. And here was the trade that I ended up putting on. Okay, I ended up buying the 25 and selling the 15. I did it it's a $10 wide spread. I'm buying the spread, so the most I can make is $10. The most I can lose is can go to zero. I paid $5.42, so I can lose $5.42. I can make $4.58. That was the closest risk reward that I could end up getting. The market did continue to sell off, but volatility stopped going up, and that was the key, because I kind of take a look at it this way. For those of you that were engineering geeks back in school the way I was, it's basically the difference between the first derivative and the second derivative. If you were a physics guy, okay, it was a difference between velocity and acceleration. If the market isn't accelerating downward, if we're just starting to end up getting a nice, smooth stair step down and controlled selling, the second derivative, the acceleration, meaning the volatility, the VIX and the VIX futures, or options on the VIX futures, or ETF on the options on, I'm about up to what, about 4 or 5 derivatives at this point. Those multi-derivatives won't continue to accelerate at the same level that they had been. They'll start to slow up. So once they started to slow up because the selling wasn't increasing, I said, okay, this is an opportunity to be able to end up taking this on a longer term trade where, quite frankly, I'm putting this trade on and I'm willing to risk, all of it, okay, to end up making, okay, my stated profit here.
Are you going to hold that, planning on holding that to expiration, Jim, or are you going to take it off earlier?
It's interesting. I will probably hold it to expiration. If I was planning on taking it off earlier, because remember, the super aggressive account, I would have traded, okay, more. I didn't trade as much because I put this on Thursday afternoon, and don't forget, Friday morning was the SPX expiration. So I still had SPX margin requirements that were rolling off on Thursday, on Friday after the opening print. And I didn't want to end up, there was, because of the elevated implied volatility, to me, while there was a little bit left to end up making on that trade that expired for me on Friday, I let that go. And so I was using my money, but I wanted to make sure that I kept plenty of dry powder. By dry powder, you take a look, the account's a little under $23,000. We're at 10 right here in terms of our available trading power. If I take a look at the trades that I had on the SPX, and here are, for those of you that don't use Thinkorswim, here's one of the things that Tom and I use all the time. What I end up doing is that I also will end up keeping, and let me just hide this and I'll show you my positions, and I will select this. And I'll take a look at what my Greeks are, but then what I'll do is I'll keep my emulated trades, okay? And I'll select this, so I have everything. And then I say, do I have I copied this properly? So I'll take a look at what all my Greeks are, and then what I'll do is I'll switch from hiding my positions to hiding my simulations, and my Greeks don't change. Right? So I know that I have the right trades on, that I can see everything that I've done. Okay. By the way, the great thing about this is that what Tom and I do is that we export our current trades. Okay. And what we end up doing is that we end up having a shared Dropbox. Okay. And then I can end up putting stuff into a Dropbox. Tom can end up pulling it into his Thinkorswim. He can end up playing with it and saying, hey, would you consider this trade or would you consider that? He'll save the trades to the Dropbox, and then I'll take a look at what he wants to end up proposing. Our way, that our nomenclature is that if we lock our prices down, those are trades that we've made. If we leave them open, those are ones that we're proposing. So it's a wonderful way to be able, with the trading partner, to be able to end up sharing stuff. And for this, in terms of analysis, is something that we really like to end up using. So what ended up happening was that my trade was rolling off on the previous week, and I had this trade on. Okay, And as we started to have a little bit higher implied volatility, and Tom, this is the butterfly that, yours and mine that we end up sharing with folks in the accounts, we use all the time. They're broken wing butterflies below the money, okay? And we have our credit spread wing or our lower wing be longer than our upper wing.
Right.
It's a bit of a challenge right now because of how steep those put skews are. It means that we're paying a lot more for this leg. Yes, we're selling twice as many of these, but we kind of have to position it so that you get a high enough implied volatility here where you still have some edge. Well, that kind of happened. So what I ended up doing was that I needed to end up having some type of, I wanted to collect more money for selling put spreads. But at the time, I had plenty of room on the upside because I hadn't sold any call spreads whatsoever in my first trade. So when volatility popped, this was the trade that I ended up putting on, where I sold, okay, basically, and here, let me move it up because you can't see the bottom put. I sold a 1960, 1950 put spread. And the reason why I sold one here, okay, and I made this, okay, 25 points wide instead of 10, was that it didn't cost me anything. I didn't have any additional margin requirements. So like, for example, when I had this initial trade on, I could sell a vertical out here, a call vertical out here, and there wouldn't be any additional margin requirement because my margin requirement is being driven down on the bottom side.
In fact,
So
it might reduce your margin because now your the max you can lose is going down on the downside. It's being reduced.
That's exactly right. Plus, it's going to be reduced by the amount of money that I collected on those calls.
Right.
And so I didn't want to end up adjusting my deltas dramatically. What I wanted to end up doing is that I wanted to end up increasing my theta.
Mm-hmm.
So by putting the second trade on, I went from 27 to over 35 and a half. Kept my deltas still relatively in check. Actually, adjusted them negatively slightly, and they're negative now. But at the time before we ran up, they were actually pretty close to zero when I put it on. So that's the monthly trade that I end up having on. I have not put on the another Kevlar fly. I will be putting one on, and Tom, what I'll start to do is what you've done, with share, because I know a lot of people have really appreciated it. I'm going to start to end up sharing, here's what I'm doing on a regular basis. So I will end up posting this probably by midweek. I'll put it up, and then I will end up showing, at least on a weekly basis, any of the adjustments that I make, and we'll put that in the forums for everybody to see.
Great. Oh, one thing before you leave the screen. If you uncheck the iron condor box, you can check the margin before and after and see what the effect is.
I take a look at what my maximum loss would end up being.
Right.
Okay, so right here, my maximum loss was $8,530. With it, it's $9,000. That's going to be a little bit more.
Yep.
And the reason why it's going to be a little bit more was that if you take a look over here, I sold a $10 wide put spread, but I only received $4.25 for it. So it's going to end up increasing my margin by the difference. $10 minus $4.25 is $5.75. So if you take a look at it, and I did it one time. So it's going to be $575, and if you actually do the math,
it works out.
Okay. It works out perfectly, right? So it's important to understand, where your margin is being derived from and how your risk is going to end up changing, for what you end up doing. And then what I end up doing is that I end up evaluating that, yes, my margin's going to be slightly higher, but one, I'm going to lower my deltas, and two, I'm going to increase my theta. So adding that little bit of margin wasn't a big deal because it was helping my overall trade. I am short, okay, the puts up here. And remember what I told you before. The problem is that the puts are trading extremely cheap on a historical basis compared to the puts below the money. So the calls above the money are rather inexpensive, from a historical base. And that's what we trade, right? We trade the difference in volatility. So, one of the things that, and I don't know, I guess some people have heard me say this, but when I take a look at the skew charts, and if I come back over to here to take a look at the SPX, one of the things that when I take a look at any of the skew charts, um, the important thing I'll take a look at is where the difference is between the two strikes that I'm trading. Because that's what you're doing, right? You're buying one implied volatility, you're selling another. In a two-legged spread, if you're doing four legs, then you have to end up really considering what parts of that curve you're buying and you're selling. So while I end up doing all of my analysis on that on Livevol, and I do a lot of my trading, I do have this one, if you will, legacy account that I still keep at Thinkorswim. And by the way, for those of you that did know the story, the very brief story of it. And Tom, if you take the ball back and show where people can end up finding where we track this, what ended up happening was that I had a small account with $6,000 in it from a Roth IRA that I put in, and I quite frankly, I forgot. Um, I had gotten a letter from the government saying, Jim, you're getting old. You're allowed to add more money to your Roth IRA now because you're getting close to actually needing it. They send that letter to you, by the way, when you turn 50. So I said, I don't know if I'm going to do anything. And then Thinkorswim sent me a letter saying, hey, this is inactive. If you don't trade it, we're going to have to start to charge you. So I said, okay, you know what I'll do is I'll start to end up adding money. And I'll try to take my $6,000, adding the $6,500 I can for the next 9 years, and because $6,000 wasn't going to make a difference in my life, but $500,000 in a tax-free Roth trading account could.
Absolutely.
So we started then doing that. And Tom, you actually did some math, okay? In order for me to hit my goal, what percentage do I have to do a year?
I'd have to look at the spreadsheet, but from my memory, it was 28% a year with all the deposits that you have planned. So that's 28% of account growth every year. So that doesn't take into account drawdowns or anything. So if you have a big drawdown, say 50%, you have to get 100% return to get back to even, and then you still have to make your 28% on top of that.
So, and basically, that's the difference. When you see the difference between average and annualized, the term annualized means that that's what you ended up having to make up for all of the losses. Average doesn't count. Because the thing is Tom just gave you the example. If you're down 50% and up 100%, you can end up saying, well, my average is 33% I'm up. No, that doesn't count. You're actually even because drawdowns hurt you a lot more than you realize in longer-term performance.
Right.
So having that consistency is really, really important to be able to end up doing that. So anyway, so this is where we end up tracking it, and I end up posting my statements. With the move up, the way we've ended up trading, the way I've traded this thing, the constant move up and the drop in volatility has actually made it more difficult. My last 2 months, I think I was down 7% each of the months. I'm up so far this month, on the trade, and I feel pretty good with the way we've gotten things started. The flatlining that we had been doing is sometimes harder to make money, trading butterflies, because remember what we're doing in a butterfly. We're selling volatility.
Right.
And when the VIX gets to a all-time low, remember we talked about this. We are at a VIX all-time low a couple of weeks ago on the S&P 500. Yes, when the VIX was measured on the S&P 100, we had a lower VIX back in the early 2000s, but it had been brutal. And as low as the VIX was last week, we talked about how the put skew or the skew on the downside had been much, much higher.
Right. And if people want to find this, all they have to do is go to our site and in this search box type in 500K, and it'll actually pull up the two relevant ones. So this is the actual article that kind of showed the Kevlar slides and how you're trading it. And there's a link to this page, which is the project current status. And I just updated this, and like you said, the last 2 months you've been down at 21.9, and now you're back up. You brought it back 1,000. So the numbers will be better for the end of July, I'm sure. But this is where they all are. It even has the broker statements. It's been redacted to protect Jim's privacy, but a lot of details from the broker, and they're all here, so you can take a look at them.
Tom, do you want anything else you want to end up adding?
No, that's it for this. Anything coming up for next week that you want to go over?
Yeah, next week, and I guess I have to share my desktop, right? We've talked about this during the summer, and during the summer it's a little bit quieter in terms of news and things that we'll end up hearing. When we take a look at next week, the two things that I think would be kind of interesting are the housing numbers, because one of the things that this past Thursday started with was lower than expected housing starts and permits, and then Janet Yellen starting to talk about those. It'll be interesting to also watch when we end up seeing the housing numbers, and also the durable goods numbers will end up being another number. Watch how the market reacts to them. We have been in a phase for a long time where I call it good news is good, bad news is good. When bad news is good, meaning where employment numbers or any type of macroeconomic numbers come out and they are less than expected, what ends up happening is that the market will many times react, oh, this is good, because if the Fed sees this, they'll lower interest rates and it'll be good for the market. So bad news in the economy is actually good news for the market. We kind of started to see the first signs of that flipping over the last couple of weeks, where if news is too good, they were afraid that the QE reduction would happen quicker. Well, in the last Fed meeting, they took all of that out, and they said that they're going to continue until all of the money is, they're not buying anything anymore. And they was even like a half a month they were going to have to do. They said they were going to roll that up and do that sooner. So all of a sudden it was like, uh-oh, we're starting to talk about interest rates moving up. And so we've started to see bad news be bad sometimes. Watch the market, see how it ends up reacting on things, not just in the, I like to take a look at how it initially reacts, and then at how it reacts, in the next hour, next day, next week. And we're definitely starting to see a little bit more volatility, but we don't see any cracks in the facade quite yet. Thursday could have been the start to it. Friday ended up showing that it wasn't. So it's, all systems are still, on alert, but we're not at the point where we're, fearful that we're going to see the large pullback, imminently.
Right. Makes sense. And those VIX futures, watching those really helps.
Yeah, it really does. It's, and we can end up going through, anybody, send us an email, okay, or just do a response. If there are specific topics you want to see us review on our weekly calls, we'd be more than happy to.
Great, Jim. Well, let's not take up any more time of our people watching, and thanks again for great insights and a nice review of what's going on from your point of view in the market, and I'm sure it can help some people do their own analysis and improve the way they trade.
Thanks, Tom. I'll talk to you.
Okay, thanks, Jim.